Hey there, welcome to our new segment dedicated to helping traders navigate the world of options. Whether you're new or looking to enhance your knowledge, you've come to the right place. In our first session, we will review three key concepts: options expiration, strike price, and options multiplier. Options expiration is the date when an options contract expires. Strike price is the predetermined price for buying or selling the underlying asset. And the multiplier determines how many shares are represented by one options contract. So hit that subscribe button and let's dive into this exciting world of options trading together. Okay, there are three option characteristics. The first one is that all options have an expiration date that is different from shares of stock, because if you buy a share of a company's stock, there's no expiration date on that position. You can hold a share of stock forever as long as the company does not go private. There's nothing that's forcing you from closing that position, but with option contracts, they all have an expiration date, and the expiration date could be today or it could be 2.5 years from now. That means when you are trading options, you have to choose a point in time for your position. So this is the first thing to know, that all options have an expiration date, and after the expiration date, that option will no longer exist. And finally, there are two types of expiration, AM and PM. We will discuss expiration and expiration types in much more detail later in the session. Option characteristic number 2 is that all options have what is called a strike price. The strike price of an options contract is the predetermined price at which the underlying security or stock can be bought or sold when the option is exercised. It is the price at which the option buyer has the right to buy or sell the underlying asset. The strike price is determined at the time the option is bought or sold, and it remains fixed throughout the life of the option contract. So an options contract at 70 is a contract that gives you the right, but not the obligation, to buy or sell a financial asset or stock at a predetermined price of $70. You can exercise the option to buy or sell the asset at the strike price of 70. Alternatively, you can also choose to sell the option back to the market at a different price if you don't want to exercise it. The actual price of the stock may be $65, but the price at which you are trading that option will be at $70. This is important and may not make sense right now, but an option's entire valuation or price is based on the fact that it has the ability to be converted into shares of stock at its strike price. We will review many examples of this to help you understand the concepts, and it will when we go through the examples. Option characteristics number 3 is the contract multiplier. This can be confusing, but let's try to take it in its simplest form. Trading stocks are pretty straightforward and simple to follow. So if you see a share of stock that has a strike price of $70, I can buy one share of stock at $70. In the option world, it is different. The option multiplier is the number of shares of stock that a contract controls. If you have a strike price of 5 and the option multiplier is 100, this means that one option contract controls 100 shares of stock, and each option contract is worth $500. 5 times 100. So if I see an option and the option price is $5, it's really not $5, it's actually $500. The option price is multiplied by 100 shares of stock, and that's why the cost of the option is not 5, but actually 500. The $5 represents 100 shares of stock, so you need to multiply $5 times 100 to obtain that actual price of the option, and it is referred to as the option premium. Hopefully you have a good understanding, or at least a better one, of the 3 option characteristics, and if not, hang in there. We will use these terms over and over again in the course, and by the end of it, it will be second nature.